Hey everyone, welcome back to Corporate Decoder, where we decode the money stuff so you don't have to. And today we're diving deep into Phillips 66's latest financial report, the kind of stuff that tells us if they're really cooking with gas or if things are getting a bit too toasty in the boardroom. Phillips 66 just dropped their quarterly update for the period ending June 30 of this year. And let me tell you, there's a lot to unpack from refinery operations to major business deals. Let's get straight to the numbers that really tell the story. First up, the consolidated statement of income. It's like the company's report card. And for the 3 months ending June 30th, Phillips 66 saw their total revenues and other income drop to $33.5 billion compared to almost $39 billion in the same period last year. A pretty significant dip. But on the cost side, purchased crude oil and products also went down, but not as much, closing out the quarter at around $29 billion, down from nearly $35 billion last year. This means their profit margin took a hit. This all adds up to their net income attributable to Phillips 66 falling to $877 million for the quarter, down from over $1 billion in the same quarter last year. That's a noticeable drop in profit. Interestingly, their basic weighted average shares outstanding actually decreased slightly, while their diluted shares also moved in a similar direction. This usually means they either bought back some stock or some stock went from being potentially dilutive to not dilutive anymore, a subtle sign about how they manage their share count. Now let's look at the cash flow statement, because a company can look profitable on paper but still be struggling for cash. For the 6 months ending June 30th, Phillips 66 brought in $1.03 billion in net income, but their net cash provided by operating activities was only $1.03 billion. This difference mainly comes from changes in working capital, like inventory and receivables, but also a big chunk went to capital expenditures and investments, which were $1.01 billion for this 6-month period, meaning they're investing heavily back into the business. Even more significant, they spent $2.2 billion on acquisitions during this time, a massive investment that surely impacts their cash position. When we flip to financing activities, we see they borrowed $3.5 billion but paid back $2.4 billion in debt. Plus, they repurchased shares worth $523 million and paid out dividends of $956 million. It's a busy cash movement story. Let's check out the balance sheet for a snapshot of their assets and liabilities. At June 30th of this year, total assets jumped to about $76 billion, from $72.5 billion at the end of last year, driven by those acquisitions and inventory increases. Inventories, for example, climbed from under $4 billion to over $5.5 billion, indicating they're holding more product, perhaps anticipating higher prices or due to supply chain factors. However, their long-term debt also crept up a bit to $22 billion from $18.2 billion last year. So while they are investing and growing, they are also managing their debt carefully. Total stockholders' equity remained fairly stable, around $27.5 billion, so the overall financial foundation looks relatively solid. Now, diving into the notes, there's some interesting news about their Los Angeles refinery. They announced plans to cease operations there in late 2025 and are already shortening the useful lives of those assets. This means they're booking accelerated depreciation, a big hit to current profits, but necessary for accounting purposes. They've already booked $265 million in accelerated depreciation, a big hit to current profits, but necessary for accounting purposes. They've already booked $265 million in accelerated depreciation, a big hit to current profits, but necessary for accounting purposes. They've already booked $265 million in accelerated depreciation for just the second quarter alone, and $555 million for the first half of the year. It's a significant cost associated with closing down operations. Remember that $2 billion acquisition mentioned earlier? Well, that was for Coastal Bend ANGL pipeline and fractionation business. The accounting for this is still preliminary, meaning numbers could shift slightly, but it's a major play in their midstream segment. They also bought a marketing business on the US West Coast for $68 million, and the numbers for that are also preliminary. Looking at revenue breakdown, refined petroleum products and renewable fuels brought in the most money at $24.2 billion for the quarter, but it was down significantly from $28 billion last year. Crude oil resales also dropped substantially, while natural gas liquids and natural gas showed an increase of about $500 million year over year, indicating a shift in their product mix. In their investment section, there's a lot going on with Dakota Access, a pipeline project facing ongoing legal challenges from the Standing Rock Sioux tribe. The company mentioned a 25% share in potential equity contributions in case of unfavorable judgments, and if operations cease, they could face significant financial impacts. This highlights a major risk factor for them. Their investment in this pipeline is substantial at 800 mention, and this pipeline is substantial at $862 million booked value. They also recorded impairments of $4 million for the quarter and $30 million for the first half of the year, compared to $225 million and $390 million, respectively, last year. This suggests that while they had significant asset write-downs last year, things are stabilizing a bit in that regard, although the exact nature of these impairments in both years points to challenges in specific asset groups. On the debt front, they issued $1.5 billion in senior notes back in February 2024 and have been actively managing repayments and issuances. They also expanded their accounts receivable securitization facility to $1 billion, a move to improve their cash flow and liquidity. Here's where we see the Propel Fools lawsuit, a big one, where a jury awarded $604.9 million in damages. Phillips 66 is fighting this verdict, and the potential for exemplary damages could mean even higher cost. This is a huge legal risk they're facing, and it's already affecting their financial statements with a significant accrual. Let's break down the performance by segment. The midstream segment saw income before taxes drop to $73.1 million from $767 million last year, mainly due to the sale of their stake in Rockies Express Pipeline, or REX, the NGL business, however significantly improved thanks to past impairments and new acquisitions, plus the sale of the Gulf Coast Express Pipeline, or REX, the NGL business. However significantly improved thanks to past impairments and new acquisitions, plus the sale of the Gulf Coast Express Pipeline, or REX, the NGL business. However significantly improved thanks to past impairments and new acquisitions, plus the sale of the Gulf Coast Express Pipeline, or REX, the NGL. The chemicals segment, which is their 50% stake in CP Chem, saw a massive drop in income before taxes from $222 million to just $20 million for the quarter. This is largely due to lower polyethylene margins caused by higher feedstock costs and decreased demand, a tough market right now for chemicals. Refining gave mixed signals. The income before taxes went up to $359 million from $302 million last year for the quarter, but for the first 6 months it plummeted from over $500 million to a loss of $578 million. This is partly due to that accelerated depreciation at the Los Angeles refinery, but also changing market crack spreads and product differentials are playing a big role. Marketing and specialties showed strong improvement with income before taxes jumping from $415 million to $571 million for the quarter, and an even more dramatic increase from $781 million to $1.85 billion for the first 6 months. This seems to be driven by higher marketing fuel margins both in the US and internationally, and the sale of their investment in Coop, a big boost to their results. Renewable fuels reported a loss of $133 million for the quarter, compared to a smaller loss of $55 million last year, and the 6-month loss widened from $110 million to $318 million to $318 million. The segment is clearly struggling with increased feedstock costs and unfavorable hedging impacts despite producing more renewable fuels. And finally, corporate and other swung to a bigger loss of $428 million for the quarter from $340 million last year. This is mainly due to higher net interest expense from new debt and increased corporate overhead and other costs not tied to a specific segment. Looking at where the money is going, capital spending and investments totaled $1.01 billion for the first 6 months of 2025, with the midstream segment taking the largest chunk at $600 million. This shows a clear focus on expanding that part of their business. On the shareholder side, they bought back about 3.5 million shares in the second quarter for roughly $395 million, demonstrating a consistent commitment to returning capital to shareholders through repurchases. That Propel Fuels lawsuit is still a major overhang. A jury found Phillips 66 liable for $604.9 million, and the company is fighting it vigorously. The potential for exemplary damages adds a significant layer of uncertainty to their financial outlook. Now for my take on all this. Phillips 66 is navigating a complex market. they're making major strategic bets with those significant acquisitions in midstream, and they did see a nice boost from the marketing and specialties segment thanks to strong margins and a profitable divestiture. However, that chemicals segment is really feeling the pressure from high feedstock costs and economic slowdown impacting demand. The refining segment is a mixed bag, sensitive to crack spreads and operational efficiency, and that Los Angeles refinery closure is a drag on profits right now. The renewable fuels part is losing money and needs a turnaround, while their total assets have grown to nearly $76 billion thanks to acquisitions. Their overall net income is down year over year, and that Propel Fuels lawsuit is a significant unquantifiable risk. The company's strategy seems focused on strengthening midstream and chemicals, but the current market conditions for chemicals and the ongoing issues with the Los Angeles refinery and the Dakota Access Pipeline present considerable headwinds. In conclusion, Phillips 66 is a company in transition, investing heavily while facing market headwinds and a massive legal battle. Their ability to manage these challenges, especially the Propel Fuels case, and improve operations in chemicals and renewable fuels will be key to their future success. What's your take on Phillips 66's performance and their strategic moves? Let me know in the comments below, and if you found this deep dive valuable, give this video a thumbs up and subscribe for more corporate breakdowns. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and well, see you in the next one.